morning, everybody. It's Wednesday, April 17th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Quickly here, overnight markets had May corn up 3/4 at 431 3/4. May soybeans were down a half at 1144 1/2, and May Chicago wheat was up 3 at 552 3/4. No export sales announcements this morning. We did have one piece of news. Private estimate out of Brazil came back and altered and raised last year's 23 bean production up 1.2 million metric tons. That was really the only fresh piece of news here this morning. Good morning, guys. I know, Ben, we had a meeting yesterday with a couple of our partners in the cash market. I know there were some thoughts that maybe you wanted to share with us here as we start this morning. Not like I said, not a lot of whole fresh news, but I think there was some interesting topics that we talked about yesterday. So throw it over to you to start us off this morning.
I think that these markets are frustrating everyone, and lack of volatility in corn. It looked like we were going to loosen things up there a little bit, but I think that the cash market is functioning exactly as it should. In our meeting yesterday, we find out basis levels in the West are solid, 20 to 30, 35-ish over type numbers, farmers going to plant, not the same volume of grain there this year that maybe they're used to where they struggled. In the East, it's been fairly flat vol, option to 5, maybe 10 over in spots. And the outlets for that grain is telling of how important our export book is, and how people react to heavily supplied markets. So a fair amount of Western Corn Belt corn has been booked to go out of the PNW, been booked to go out of New Orleans, and then certainly to their feeder markets. And in the East, we're a tributary to a lot of the animals in the Southeast. They feel that it's going to come to them because they know that we're sitting on a tremendous amount of grain. But ultimately, it comes back to the market is working and it's adjusting itself via basis as opposed to futures right now, and offsetting in different geographic locations. So there doesn't seem to be, we don't need that big push up to go secure bushels. Not to say we won't have or can't have a short covering rally, but I think it's just, we talk in generalities about futures prices and about basis, but ultimately the combination of the two is what drives our markets. And it's an inverse of what we typically see, where the East is in a corn deficit area. And we see stronger basis levels kind of working their way in there as the amoeba to source grain has to grow. And in the West, typically they're more heavily supplied. And it's an opposite fact this year that there's an abundance of grain in the East, and maybe not quite as abundant in the West. So worth keeping in mind that they felt like, in the West, 450 to 460 definitely moves some corn their way. And in the East, I think people would love to see that kind of basis level would certainly jar loose a lot of corn, which leads to an entirely different conversation of what happens when we get into, early mid-June, late June, if people feel like, hey, we've got a pretty good crop here, right? With people in the Southeast, the main tributary of a lot of that grain, they may be sitting in the catbird seat as a lot of people have to come and really start hauling this grain that's been held back in storage that's unpriced. So I think it gets to be a really kind of a tricky time there. And if you have a lot of grain to haul, you probably want to start looking around at that area. Now, the flip side is we have a significant problem. We have major delays. People shut the bin doors. This happened in 2019 in the East, but you're getting some of it looked at and set now, I think might be beneficial.
Looks like, yeah, that's good. So Ben, I think that the takeaway is that you've almost got a little bit of a flip between, your Eastern belt and your Western belt from year ago. It's like just polar opposites of what the basis story was from last year, was my ultimate takeaway.
Yep. And talking to a friend down near the river, he mentioned that it's the least amount of corn that they've seen go out between Louisville and Cincinnati in the last 5 years. So we in the East, they haven't been able to participate in that. There hasn't been a pull on it. They haven't needed to go that far up the river to get corn for export. So I think on a forward look, that June, July, August could be really tricky if we wind up being with a good crop. Commercial sitting on a fair amount of corn as the people in the Southeast just wait and let the carries roll down to them and buy it that way. So I would not want to be holding on, I guess, and it could be completely wrong. I would not want to be holding on to a lot of corn unpriced, no basis going into that time frame.
Sure. Chairman Powell was out yesterday. Dustin, I'm sure you had a chance to take a look. I thought it was pretty interesting. We've talked a number of times on the show about some of the politicization of the Fed in an election year, and I thought his comments were quite interesting, that it's inflation obviously being remaining stubbornly high, that his feeling at this point is that rates have to stay where they're at. I think he's kind of softened his tone in terms of that rate cutting program that he had mentioned a number of times in previous weeks. I don't know if you had a couple thoughts there.
Yeah, so I think the market has been almost really overly hopeful that there'd be a lot of cuts. We've seen the market basically be called out as wrong so far. The last couple of months, especially, they had to make adjustments about expectations of how many cuts we're going to see this year. And as this inflation data keeps coming in hot, we have to remember, this is like, they don't get this right. We've had this happen before, right? Inflation wasn't fully quelled last time around, going before the Volcker years, right? And then they had to go way past what they thought for a benchmark rate to restore confidence in the U.S. dollar and the system itself. So that led to some pretty big disruptions in the market. And I think at these type of debt levels, it's unthinkable of what would happen if we let inflation get away from us. So if they don't get this right, there could be a much larger problem on their hands. So I think it does make sense that they're pausing and they're trying to be rather conservative on this, especially economy is still looking strong, stock market's still near all-time highs. The time is on their hands to kind of wait and not get ahead of themselves and cause reflation to continue. So, but that's not really, higher rates for longer is not really real positive for, commodities in general. A lot of times we see wider spread markets in those situations. So just something to think about for corn is we have, we've been in the higher, past 50% of full carry here for a lot of these spreads. We have had some narrowing July to Dece, where we are looking at a fairly good export program to Mexico right now for corn. So, but we haven't really shipped much to China, and we are still left with a fairly sizable carryout. If we are going into 24 with a fairly sizable carry in, and we pick up acres on that next June report, and we have something that's within 5% of trendline yield, there's a good chance that next year's spreads will continue to be wide in this type of interest rate environment, right? So that's another just way to think about the market is, if we're hedging bushels, the first bushels that we probably want to hedge are going to be, somewhere around that December timeframe, right? Just to expect that's going to be our window where those are the bushels we have to have a home for anyway. And like last year, what did we see? We saw extremely wide spreads in that higher interest rate environment. Part of that was the river problem, of course, but part of it was the market was surprised at their first glimpse of these new carry rates. New carry rates they're not really new. They changed to a CME warehouse approximate charge of 8 cents a month back in the DEIS of 19 contract. But you look back through all of those years from DEIS 19 till today, we really haven't had a year to test how wide carries can get from market abundance. We've had a ton of years where we were running very tight on corn. China was a big buyer during those years. We had that in the 19 crop. We had that really delayed planting window that led to a large drop in production. We didn't find that out till later, but we really haven't had that testing until this 23 contract came about, and then now all of a sudden spreads blew past where many in the market were expecting, just because they're looking back in history of where spreads go, and they're not accounting for that new charge of 8 cents a month instead of 5 cents a month. It makes a big difference on that, what should be a fear for the longs of what delivery would cost them to actually have to hold that physical receipt. So I just think that that's something to consider when we've had a lot of people kind of worried about, not only DEIS 24, but DEIS 25. There's still that spread is only 20 cents right now. That's not a big portion of full carry. I don't know that DEIS 25 has an immediate risk compared to DEIS 24. I think DEIS 24, if we do pick up acres and do have trendline yield, that's probably our bigger risk on the table at the moment as growers. And that's, what you want to measure in conjunction with your advisor here. Where does your crop insurance floor kick in? What is the fallback plan that you've established while you're waiting to make profitable cash sales? Is there some sort of insurance play or option play that gets you the bridge on coverage to make sure that we're stable on income? Or, and when do we make that decision? That's the hard part right now, is that we're kind of in a counter seasonal negative territory where many growers don't have profitability. They can't just go out and, simply make some sales and know that those are going to be profitable sales. University data continues to show that cost production is, a good 50, 60 cents higher here for the majority of growers on corn. So it's a rock and a hard place. I think it's going to be a really, really tough year. It's if I had to guess what's going to happen for margins. So the next 60 days will be something that I really want to focus on, is how do we bridge from, all these costs that we've signed up for this year to getting through this 24 season rather unscathed. That's our main focus right now.
That's good stuff. We got a couple minutes here before we come into the open. Ryland, I know we talked briefly yesterday. We've got cattle on feed due out on Friday, 2:00 Central. What did we see? Did we see any cash materialize there yesterday, or what does that look like as we started the week?
No, we really haven't seen any cash trade at this point, Dan. And yeah, I think just overall, we've seen a little bit more of the market starting to settle a little bit after all the headline trade, I think, just with, the situation in Israel, bird flu. I mean, it seems like market's trying to move past those a little bit right now. So we've actually got some upward trajectory. We had a pretty good, relatively decent technical close in April. Contracts and into the June contracts, you're just finally crossed back over the 10-day. So just little indications like that. We still haven't seen any cash. I think the market's trying to figure out if we're going to stay relatively steady or not this week, but slaughter was down just slightly. We're running about 1,000 head behind last week to this point, but I think it's a little too early to take too strong an opinion on there. We have been hearing some recent it just kind of feels like there's some dryness going on in the south, and just overall, I think that's a little bit concerning. But overall, we could see a little bit of a deviation here between cash in the south and cash in the north. So I think that's something to keep an eye on as well. But yeah, the real focus is going to be on the cattle on feed. 102 on feed, 92 placements, and 89 for marketing. So those are the numbers right now that I think the market's trying to price in. That lower placement number, and the marketing number. There's still 2 less marketing days in March versus the previous year. So I think that's what's kind of affecting those big percentage changes. So overall, we'll kind of see what the numbers say. If there's anything out there, we'll give our opinion on that when it comes. But right now, it's just going to be mostly kind of cash trade. I think at this point, that kind of guides direction. Maybe we do see a little bit of risk off before this report. But overall, it seems like momentum's starting to turn a little bit more positive.
Oh, very good. We will also, one item of administration, we'll have export sales out tomorrow morning, 7:30 Central. So we'll talk about that in the war room as well tomorrow morning. Just came into the open here. We've got May corn up 3/4, 431 3/4. May soybeans are down a half, 1144 1/2. And May Chicago wheat's up 3 1/4 at 553. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate all the thoughts and comments here this morning, guys. It was a good conversation, and we look forward to talking to everybody there tomorrow morning. Have a great day.
Thanks, Dan.